We've got Allianz Chief Economic Advisor Mohamed El-Erian joining us live right now. Mohamed, thank you for getting in the chair. Do me a favor, play the role of shrink for the markets at this very moment. What is going through the minds of the markets as we head into this Friday?
So I would say I understand why you're upset. You've had the worst week since March. You've had a second month of losses. And you know what? Your bonds have sold off as well this month. So this is a tough time. The investors will feel they're getting hit from all sides, and even your favorite names are nursing big losses. So I understand why you're upset. I understand why you're hurting. You need to understand why this is happening, and you need to maneuver accordingly.
Dr. El-Erian, I'm laughing because we're anthropomorphizing. I mean, we're putting a human face on the markets, but all of our viewers really feel this very closely at the moment. And specifically when we look at the tech wreck, you see that as a real bump in the road. First, can you give us a roadmap of what you expect in the next couple of weeks? And are these opportunities? Because Apple right now is certainly losing some steam over the past week, but you wouldn't be buying it at the highs we saw last week.
Right. So we had three very big drivers to this market. Improving economy. We were coming back strongly, as you saw from the third quarter GDP numbers. Policy stimulus, and investors confident that the central banks would support us, that the Fed would support us. The fundamentals are no longer improving as fast because of COVID. Stimulus is not going to happen. Maybe the earliest it'll happen is early next year. So investors are relying on just one thing, liquidity conditioning. And what happened this week, and the reason why tech got hit hard, is for the first time, tech started warning about what's ahead. Even tech can get whacked by what's going on. So I think this is a repricing. I tell people, if you are in names that you understand and you like, stay there. If you're eager to buy, wait a little bit. Let this play out. We still have a few more days of real uncertainty, not just the election. I'm actually worried less about the election. I'm more worried about the Federal Reserve meeting next week. And are they going to tell us something significant? So wait a little bit, because my gut feeling tells me, Liz, you're going to pick up good names at better prices down the road.
Why are you worried about the Fed, Mohamed? Now, we want everybody to know that the Fed meeting is November 4th to 5th. It's that two-day meeting. And what is disconcerting about that for you? Are they going to reveal what they see?
Well, they need to do something, because the marketplace has been conditioned that the minute it sells off, the Fed comes in and increasing liquidity. We already saw the ECB, the European Central Bank this week. They reacted by saying, we are going to do more, and nothing is off the table. They talked about recalibrating. That's the word that our friend, the president of the ECB, Madame Lagarde, used, recalibrating. So US investors will expect the Fed to say something, but the Fed is in a really difficult position. So if the Fed doesn't say something comforting, then this market will take another leg down.
What about bonds? Can you give us that roadmap for treasuries?
And that's the irony, that in a month in which stocks have gone down and people had 60-40 or 70-30, 70 stocks, 30 bond, they look to that bond allocation and say, well, that at least made me money in a world in which risky assets went down. Surely risk-free assets went up. And the answer is they did not. They also lost money. And it tells you that we are coming to the point where bonds have been so distorted by central bank action that they no longer behave in the way investors want them to behave. So the only risk mitigator in this world today is cash.
This is fascinating to me, cash, because you anticipate maybe there will be better entry points in this. And as we finish up, can you just give me a sense, because the least worst sector right now is materials, then financials, and then industrials. So putting aside financials for the moment, materials and industrials, do you feel that that's an opportunity at the moment?
Not yet, unfortunately. The global economy is slowing. Europe is going to enter possibly a double-dip recession. Things are shutting down in Europe. and China can't carry the global economy on its own. So no, I would say I would wait and enter tech companies at better levels.
Tech companies at better levels. All right, but the high for Apple this year has been about 137. Of course, there was a split, but right now we're looking at Apple at 107. So, something's on sale here. Mohammed, have a good weekend. Thank you so much. Perhaps we'll see you next week. It's going to be a wild one. Thank you very much.
Thank you.